Hello, everybody. Welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm thrilled to welcome Henrik Zeberg to the program, head macroeconomist at Swissblock and an expert in business cycles and technical analysis. We're going to discuss his thesis of a blow-off top in the broad market, leading to a devastating deflationary bust worldwide, and attempt to gain some perspective on how close we could be to an event that could wipe out a massive chunk of the market's value. We're going to talk about the market impact of the war in the Middle East and ask the question, is it even worth paying attention to news headlines as an investor, or is it all just a distraction? We're also going to get his current outlook on gold and gold mining stocks, the global economy, and much more. Before we dive in today, Commodity Culture now has merch. Get your hat, t-shirt, hoodie, or mug, all backed by a 100% quality guarantee by hitting the link in the description below. And now, my friends, strap yourselves in for my conversation with Henrik Zeberg. Henrik Zeberg, great to have you back on Commodity Culture. I want to start off by asking what you make of the recent price action in the broad market in the face of what appears to be an escalating conflict in the Middle East. We've got these on again, off again ceasefires. Nobody really knows exactly what's happening. But I think a lot of people expected at least a significant correction. It's been holding quite steady throughout. Now, of course, if we look at the S&P, for example, year to date, we're only up 2 point something percent. So not a really strong performance so far this year. But these events with this escalating war didn't seem to make a massive impact. I'm wondering why you think that is and how you expect the broad market to perform.
Yeah, and first, good morning, and thank you for having me on again, Jesse. So I think if you go back in time and you take a look at how wars, when they've had the breakout of wars, the war in Iraq back in 2003, and you saw also when NATO was bombing in Serbia, and in all these, you normally see that the stock market doesn't necessarily doesn't start to crash because of that. It's more the narrative. So again, to me, I mean, it makes sense that the market hasn't made not a lot of notice of this. I think it's been more of the narratives, and we actually see from April on that we have seen a strong development in the markets, and we are heading up. I think the Nasdaq just hit a new all-time high yesterday, as I was expecting, also in April, and I don't think it's going to be it'll not be because of the war narratives that we're going to see a decline in the market. I don't think it will. I mean, it's always difficult to say what will be the reason that people will kind of take in. To me, we are now we've seen a strong rally since the low in April, and I think I said back then, I think we're going to move right up to an all-time high, and then we may have just a kind of a pause here, and then I think it's going to continue into the autumn. And I think that's what we're going to see. What is going to be the narrative that may give us this kind of summer doldrum that I think we're going to see? I don't know. Could it be something about the narratives about war or something, like that? Potentially, yes. There will always be something that the media pulls up. But if you really go back and take a look at it, normally wars is not a thing that is, bringing the stock market into a decline. But we never know what the narrative will be. So, people watching this 3 months from now will say, oh, Henrik, you're wrong, because it was actually the narrative around it. But to me, that there will be a pullback in the market into the summer. And who knows what the narrative will be, what people will kind of see as the explanation.
So oil has been another asset category that has appeared to defy expectations. WTI crude initially spiking when Israel first began attacking Iran. Trump announces a ceasefire, prices plummet. Although now, as I was saying, it appears the ceasefires, who knows if it's on or off? I mean, every few minutes on Twitter, there's some new update about what's going on. What do you make of oil's price action? And if this conflict really ramps up again, could we see another price spike, perhaps more sustained? Because, of course, if Iran does somehow close the Strait of Hormuz, whether they mine it or whether, I was talking to Doomberg and he was saying, well, the risk could just get so high that the companies refuse to send vessels, they won't get insured. So that's obviously a huge amount of the world's oil supply cut off. If an event like that was to happen, do you think we could see a more sustained rise in the oil price?
But now we already, we are jumping into something that everybody knows. So this is probably already priced in. So it's not like this is some piece of news. And actually, we're standing where maybe with the worst kind of scenario, and that's where we are thinking that it's a likely scenario. So probably this is already priced in. You're already seeing suppliers of oil starting to think in terms of new routes to get the oil out. So I think this is where people like to be able to front run the price development by coming up with a narrative, but actually it's already priced in. So I think and as I also expected technically that we would see kind of a spike in price after we saw the decline. I think it was April. We saw a rather large decline in oil and an oil price, and then we would see a kind of a bounce again. And I think we're going to drop. I think we're close to, I would say, close to seeing a top for this spike here, and the price will start to continue lower because there is a slowdown in the economy, and that is by the end of the day what will drive the price of oil. There is a supply and a demand. The demand is waning, and I think there's going to be a drop in price, and I think it can be quite strong going into later this year. So all the things around what's happening down there is already something that is being worked on right now, and that's why we will see probably that there can even be taken measures now that will try to prevent these things, or which could then be putting a pressure in the opposite direction. So this is where often we see that oil didn't do as we expected. No, because it was actually kind of being already factored in. So I don't think you're going to see a lot of a spike from here. I think you're going to see a reversal around this area here, and I think you're going to see a strong decline into next year.
And now a quick break to hear from our sponsor, ARC Silver Gold. Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Is there a lesson to be learned here, do you think, in that big headlines and this sort of doom and gloom reporting aren't a reliable indicator of potential outcomes for financial markets? Is there any edge to be gained by following the news cycle closely? I mean, a lot of us are addicted to it because platforms like X, news is coming out 24/7. We're getting minute by minute updates on what's happening with Israel and Iran. Is this noise that most investors should just block out, or is there any value to be gained in following it?
I think it's noise. To me, it's noise. What I use it for is sentiment. So I use I don't when we start to see people flocking around a certain narrative and say, oh, now this is happening and that's why you must be wrong, Henrik. Then I'm like, oh, okay. Seems like they are now all the lemmings are all running into one corner and then saying this. Probably we're going to see the opposite happening then, or something like that. So I don't have the news going on all the time. Obviously there will be some spikes if things are unexpectedly starting to develop, but nothing of these things are unexpected. I mean, people that are really following oil and are trading oil on a daily basis would have seen that Israel at one point would say, okay, enough is enough. I mean, we don't want the Iran to have a nuclear bomb. We're going to do something about it. It's not something, I mean, if you and I sat down and thought about it, we would also think, yeah, obviously. And people following this will already start to factor that in. So I think that, when it comes to the news stands, or when it comes into the to the television or wherever it goes, well, it's already old news at that point. So I think that is where people are sometimes trying to make sense of something which is past, already past, and that's where they should start to think, okay, if this is where everybody's running now, what could then be the reaction we could see to that for happening out of that? And right now I'm seeing this de-escalation would be massively would be bullish for things. If there will be some kind of continuation of this, well, this is actually kind of priced in as well. So I don't think these things are so important in the long term. I know people will say, oh, Henry, you're wrong. I think the volatility you can see on a daily basis or maybe within a week can be caused by what you see there. But in the long time frame, it's really about what's happening in the business cycle, what is happening in the real economy, which is the 70% of the lowest earning consumers in the economy, which is making up the economy. It's not about what people think, oh, now this happens, that's why, these. We like to think like that because it makes it easy for us. And we like to have a cause and effect, and it should be simple. But the thing is, a variable and the understanding of the oil price and of the anything on a longer time frame will be dependent on hundreds of variables, not just one or two. And all these things are being worked on by people on a daily basis, taking care of their jobs, making sure, okay, now it's my job to make sure we don't get stuck with our oil. What am I going to do what kind of business I'll be in there? I mean, I will probably see if I can get, out away from the Hormuz Strait. And so I think people are jumping into these narratives. And that's why when I talk to my people also at Swissbank and they say, oh, Henrik, but you got to see this now. I'm saying, guys, narrative doesn't drive price. And sometimes it's actually interesting to see that we are seeking desperately to find the narrative that will fit into why we see this particular development, and often we see the opposite happening. And I think this with oil price now, everybody would expect now oil price just to continue up, and now we have a stalemate or a situation down there where it can be causing oil to actually to keep continuing up. I think you're seeing that the economy is slowing, and that's a much more important long-term factor, medium to long-term factor, than what we see on a short-term basis.
Yeah, very well said. I want to talk about the US dollar for a moment here. We've seen fairly significant weakness so far this year with the DXY down 10% year to date. What is your current assessment of the US dollar? And is it still the prettiest mare at the glue factory, or are there other fiat currencies that you think could perhaps outperform the dollar? I know there are some already, but over the long term.
So technically, this does not surprise me at all. And actually, I have a tweet back in January, and also for our clients, where I said, guys, we're going to see a big drop here. We're going to see a big drop in Dixie, and that was a point where everybody was sure that the tariffs and Trump and everything would make sure that you're going to see a strengthening development or strengthening dollar Dixie. And we did not see that. We actually saw it reversed in that January, and it started a strong decline. And people can kind of struggling with that and saying, "Oh, it's because now you have you're starting to miss or to lose faith in America, and we have a reversal of all that." And you know what? As I see it, it's part of a structure, and it was actually quite visible that we would see a strong decline there. We're not all at the bottom yet. I think you're going to see a kind of a bounce in the Dixie here at this point, but then later into autumn, you're going to see the final decline in the dollar. So coming to your question, I don't think we are anywhere near, and I would say near the top of the Dixie. And what do I mean about that? We had a dollar bull market that started in, I think it was March of 2008. And that was because there was a liquidity shortage that started to develop. It was because there was a financial crisis already going on at that point. That started in December 2007, and the dollar bottomed out in March of 2008 around the Bear Stearns crisis. And that is still going on. I think there is a dollar shortage in the world still. And we have seen how the dollar has been moving up. So if you take from 2008, it's been going up like this. And I don't think that rally is done. So if you ask me where we're going to be with the dollar in, let's say, a year to year and a half's time, probably only a year, I think you're going to see that the dollar has moved to 120. And that 122 maybe on the Dixie. That is actually touching up technically on the top that we had in 2001, 2000 to 2001. And it'll be massively deflationary. And all this is actually now already starting to play out, because you see that you have a Fed right now that is extremely hawkish at this point. I mean, I don't agree with J.D. Vance on many things here. Obviously Greenland and everything that's going on, and me being from Denmark, I mean, I think it was ridiculous. But anyway, that he comes out and say, I do not understand how Powell can be so hawkish right now. I have to give it to him. I put a tweet up this today also on Twitter and saying, I completely agree. I mean, it's ridiculous what the Fed is doing right now. They are so far behind the curve. What does that create? That creates an even more toxic environment. It will not in the short term. Again, remember here, guys, I'm not talking about what's happening in the next day or 2 or 5. I'm talking about the general setup for the dollar here, and I think you're going to see a strong dollar coming down to 96, 97 on the Dixie. Again, not in a straight line. I think you're going to bounce first, and then we see it down into the September timeline. But from September, October onwards, and into next year, I think you're going to see the dollar strengthening a lot, and that will be the consequence of the policies that we have from Fed right now, because the Fed right now should already start to think, oh, we actually need to supply more dollars to the world because the world is slowing and we need to be more stimulative, and they are not, and that is going to be a problem. So I think you're going to see a bounce here around these ranges here to around 103, maybe 104, and then I think you're going to see a very strong decline down to 96, 97 before you see a very, very powerful move into a recession, and that will be when this offset of the recession that I've been talking about, we are getting not there yet, but we're getting closer, and we will see a very, very strong dollar going into that, as I see it. So I think the world will be starved of dollars if we see this, interview a year from now. I think the dollar will be very, very strong.
Well, you mentioned Trump's tariff policy, so I'd like to get your thoughts there. I mean, it seems to have all been forgotten by the news cycle. We don't hear anything about it anymore with all of this global conflict that's raging. The way these tariffs have been rolled out have also been kind of a mess with this on again, off again. We're pausing them, we're raising them, we're lowering them. I mean, it's been so confusing. I think a lot of people who are affected potentially by these tariffs have no idea what to do, because well, maybe tomorrow he'll reverse them. So it's a very confusing situation. Ultimately, how do you think these tariffs could impact the global economy? And is there anything positive about these tariffs being implemented?
Let's start with the positive side first. If you look at the economy, nothing. If you look politically, if you want to protect something, you want to protect technology, maybe. But and then there may be, and like short term for certain industries in the US and elsewhere also. I mean, because again, they will also be matched by other countries. A short-term effect of that, because you don't get the competition from abroad. So let's take the US, for instance. They don't get the less competition from abroad. That may sound like a good idea, but first of all, it's not a good idea, because everybody is good with competition for as long as the competition is fair. So let's take two, countries, or let's take two, zones or regions. Like take Europe, EU, and the US. If we have two partners there, we are partners in the US and Europe, hopefully, and should be for forever. Well, there should be no reason why we under the right kind of terms, trade rules, regulations, should be trading with each other as much as we can. The more, the better. It may feel good for a certain producer, manufacturer of something in the US for a little while, that they don't have to do, to see that kind of pressure. And they may also claim that the Europe is competing on unfair terms. Well, I don't think that's the case. But okay, that may be some of this voicing. But it was not a good thing even for the consumer, even for the producer in the US. And for the consumer in the US, it's a bad thing. Because if they can go buy their avocados for Mexican avocados for, let's say, $10, and American avocados would cost you $12. Well, if you're putting a 25% tax on Mexican avocados, they will cost $12.50 all of a sudden, which means that you can either buy the American ones or the Mexican one. Then you may shift to the American ones, but that still means 20% price increase for you. So the immediate effect on a tariffs for the consumer in the US is a price increase. That's also what the Fed is saying right now. Where I think the Fed is missing a lot of the whole point here is that the Fed should also consider what is called the income effect. So the income effect, there is a substitution effect, which means that when you see that the Mexican avocados all of a sudden cost 12.5, you'll say, okay, I'll buy the Americans instead. But the problem is that they cost you 20% more. So which means that you probably say, I don't even want to buy avocados any longer because I can't afford it. So I will then shift away from that, which means that there will be a downward pressure on demand. And that is not what you want. So the secondary effect, the initial effect, is an inflationary rise in prices on consumer goods in the US and elsewhere. But the secondary effect will be a lowering of demand. And if the demand goes down, the accumulated demand goes down, that will put a downward pressure on consumption. Downward pressure on consumption puts downward pressure on GDP, and then you have lower growth. So it's not a good idea. And that's why, and it will also be more expensive, to simply get, intermediates for your production and things like that. So companies in the US will have to spend more for that. Prices will have a upward lift for that. That's why I think the Fed is looking at this with, some concerns. At the same time, they are then missing the whole thing, which is that the consumer is right now struggling already, and that will have a downward pressure on consumption, which I think is the big schisma here. Simply that the Fed is following the immediate effects, which may be right, but they are missing the bigger effects, which is turning the wheel and turning the consumer down. So I think short-term inflationary, medium to long-term, it will be deflationary, and that I think is a big miss that we have from the Fed side.
Let's discuss the gold market for a moment. I know that you have stated you believe that when this deflationary bust takes hold, gold will fall before rising much higher in the aftermath. I'm wondering how you view the major accumulation of gold by central banks and if that could potentially change your thesis in terms of central bank buying being able to hold up the gold price, particularly if we see it accelerate up ahead. A lot of central banks accumulating gold this year as well. I think Poland is the major buyer so far. What are your thoughts there? Do you think it's worth holding some gold in a portfolio today, or would you stay away until after this bust you see comes?
I also have gold. I always have physical gold. I mean, it's a must-have, and I think into a monetary experiment that we have seen since 2008, where we kind of think that we can create wealth out of printing money. Obviously, you need to hold gold. I am, however, also in the Warren Buffett camp that I don't think gold is something that will just be the end of be all. And it's not. There will be other investments, also that will be better. And but into what I think can be a very, very serious crisis that we'll get into, because we are standing at, as what I see now, and we're getting closer and closer to that moment where, and there is a reason why the central banks are buying up gold, and especially the ones that are thinking a little ahead here, that we will need to see some kind of monetary reset at some point. And I'm quite certain, and if you look at SPX versus gold, and you look at Bitcoin versus gold, and you look at all these ratios, which will give you an idea of where things are developing. Then let's start with the SPX versus gold ratio. Then you actually see that there is a massive breakdown lower on the SPX versus gold, which you can only compare to actually four, see if I can remember them all, big events. So the big event of 1929, actually, where you had a big, massive breakdown of gold after the 1929. Gold started, actually developing much faster and outperformed SPX. You had in the Bretton Woods, at the moment when we had Nixon came out and made the temporarily stopped the convertibility of dollars into gold. Also a big, we saw the crossover there and a big decline, and you saw it into the 2000 top, and now we have it again. So these are the four ones where you can actually look at. These are massive events. 1929, what happens in 71, what happened in 2000, and now 2025, you see this crossover. So gold is going to shine over the next many years, and that's what I've said also. That if you're going to seek, if you're going 10 years out, and I had to hold the SPX or I had to hold gold, I would hold gold, because I would see gold was actually in that ratio. I could see gold outperforming many, many times. Because we are in a massive equity bubble, and that massive equity bubble is going to burst at some point. So now you're asking me then more on a more short-term time frame. I think also that this whole narrative has been spoken up. We have been talking about inflation, and we just talked about how I think inflation is not going. I think we're going to see a massive deflationary bust. Normally, when we see that, we would see also that the ground kind of opens up, and there will be a cash need for cash, simply that there'll be black swans coming out. There will be a lack of liquidity, and especially with the policies that we have seen from the Fed. If I'm right on that, and you see that the Dixie is going to 122 or something like that, you will probably and most probably, and I think it's going to be happen, it will happen, that you're going to see a very big decline in gold, and much bigger than most people will expect. Will I still be holding my gold? Sure. Will I be buying more at that time? Sure. Do I think we have seen an overperformance and not a bubble, because it's not a bubble, of gold at this point? Yes, I do. And I'm not following those who says it's just going to continue up from here. Because if you look at, silver, gold miners, you look at the platinum, they haven't been supportive of this. So I think you're seeing a pre-reaction in what is going to come that will pull back first into a deflationary bust, but then I think you're going to see it coming after, because of this big, as I talked about, break of the SPX versus gold, which will create a fantastic market, a fantastic development for gold into 2030s. In that time frame. I hear 10,000, 15,000. I think gold can reach 35,000. I've had some projections on that, $35,000 per ounce, right, in 10 years' time. See, that is the real bull market. The real bull market are the ones you had from, I think it was in 77 to 1980, where you saw in 2.5 years' time, you saw gold up 5-6 times. That is a bull. That is the market that I'm expecting. What we've seen now is gold has been performing well. Yes, it's up 100% since, I don't know, maybe 10 years ago or something like that, or right? It's of course a very nice development, but it's not the kind of move that I think you're going to see when you see the real takeoff. But obviously, it's been going higher than I expected, and I think the pullback will be a fantastic opportunity to buy into it. And gold will have its shiny day. Actually, if they're coming back to the other ratio that I just mentioned, Bitcoin versus gold, actually that looks extremely bullish at this point. So I would say Bitcoin over gold at this point. But it gives me also as a kind of a reversal in the future at a much higher level, though, where we're going to see again gold potentially going to reverse and being outperforming even Bitcoin. I don't think a lot of people is actually seeing this at that point. At this point here, I think that will be what kind of world will we be in if I'm right that Bitcoin is going to be outperformed by gold. I think you can see that. At that time, I'll shift my Bitcoins, my crypto, and whatever into gold. So it's always a relatively game here. You want to hold gold? Yeah, right. But you actually rather have hold Bitcoin over this time frame, right? Because it's been performing much better. So it's always a relative game. For now, I'd rather hold Bitcoin. I'd rather hold certain assets in the stock market for now, but rather actually Bitcoin and crypto than I would hold gold. But there will be the time where it'll shift, and I think the Bitcoiners will see the gold bucks winning the game over the next many years.
Well, I think a lot of viewers of this show would be happy to hear about gold outperforming Bitcoin, because my audience absolutely hates Bitcoin. I'm personally overweight Bitcoin. I think its performance has been completely undeniable. You just mentioned the word Bitcoin on this show, and there's going to be at least 5 people in the comments telling you how stupid it is, and it's just funny money.
But let me just put that straight. I'm actually right these days here actually sitting and looking at this, and I've been in a couple of shows here where I'm sitting with people just patting each other on how fantastic Bitcoin is and how it's going to redefine the world. I don't see that. I see the performance of Bitcoin, of what we have seen over the last many months, years, but I also see it as a speculative bubble in terms of what we see in crypto. It is a speculative bubble. And what we see also is that there is likely more to this bubble. And a bubble is not bursting the day you discover it. It's like, oh, there's a bubble and then it bursts. No, it's not like that. It can go on for longer than we can stay solvent. And I think that is what you're going to see here. I think you're going to see that Bitcoin will hold up yet longer now. But there will be a day where this was a reverse completely. And I am, if you have to ask me, and I have to say, are you one or the other? I'm the gold guy, even though I'm bearish gold now relatively to Bitcoin, because I think that gold has a status, has is the end of be all in terms of what you need to have if you want the day where you see a monetary reset. And what we go into now, having something as speculative as Bitcoin, which can drop by 80%, with organizations all around the world having leveraged up on this now, having MicroStrategy out there. If it goes below 50,000, I mean, it will be a domino effect on this. I don't understand why people can't see that. And then yet you have treasury departments around the companies. They're just buying Bitcoins at this point. I'm not there. I'm just saying, and this is to the disbelievers or the haters here that may comment on this show here. I'm saying, I am the gold guy also, but I'm just right now saying I think Bitcoin has higher levels to go, and it will outperform gold quite strongly actually into the next phase here. But come the next phase where we see the deflationary bust and we see the Fed coming out, gold any day.
You did mention the gold miners briefly. I wonder if you have any thoughts there. They have now been fairly decently outperforming gold year to date. If we look at the GDX and the GDXJ ETFs, do you think there's a potential opportunity here in your view? Could we be overbought? Are you watching the gold mining sector at all right now?
Oh yeah, I'm following it closely, and I'll be the biggest buyer of some of these companies. But the reason that they haven't really moved higher, I mean, look at Barrick's. I mean, Barrick. I mean, the largest gold miner in the world. You probably can correct me if I'm wrong. It's probably the largest still, right?
It's at least one of the largest, yeah.
One of them, right? Yeah. And I follow them closely, and I will be buying it at some point. But it's not now. And the setup you see has been going sideways in a kind of a very clear correctional pattern, which people don't like to hear. But it's like it has to go up now. It has to move now because gold is moving. I think you're seeing actually the Barrick and the likes are actually showing us what is the real direction of precious metals here, whereas you have seen gold maybe outperforming because of the narrative again. People are trying to front run it, the inflation narrative. I tell you, the day will come. It's coming, but it's just not there yet. The day will come when we see the next, when the Dixie hits and 122, if I get that right, gold and miners are going to drop. And when the Fed comes out there, go back to the Big Short movie and say, okay, the moment they kind of convene at the Congress, or when the Powell or whoever is going to be the central banker there will come out and say, okay, do something. I think that's going to be the moment, because that's the moment they're going to introduce something of monetary. They're going to print a lot, and increase the balance sheet. And I think the thing that you can see right now, and I have what I hope will be a famous chart one day, is the chart of the 10-year yield, actually from 1912, I think. And you see how we have had the yields going up, coming down, going up, coming down. And you can really see how we're now in a new inflationary regime where yields are starting to move up, which means, again, pointing back to that, this is a major shift that we're seeing right now, that we are now in a new inflationary regime where we may see pullbacks, but in the long time frame, we're going to see more inflation over the next 40 years. We have had the inverted Volcker moment in 2020, when the Fed and everybody else came out stimulating into a supply crisis. That is not what you do. You don't stimulate demand into a supply crisis. But they did that, and they got inflation. And even worse, they got inflation expectations, which is something that builds into the backbone of you and me. Because otherwise, people wouldn't have known. Young people today would never have seen real inflation. If they were down at 0%, 0 to 2%, it's nothing. But now we think, oh, you can actually get 9% inflation like this. And now it's actually taking over a little too much. And this is also what the Fed is actually a victim of. They think, oh, we got all this inflation. And then our core PCE number is at 2.5, and we need to get it to 2%. That is an overreaction. So I think the whole inflation narrative has been overdone. And that is normally what we see. The pendulum always swings from one end to the other. And now we'll see it swinging the other direction. I'd rather buy when the pendulum is at where we're going to see deflation and the Fed comes out with their guns blazing, then I want to buy it at a time where everybody thinks that you're going to get inflation, because that is not what you want to see. So let's have that pullback. Let's see if I get it right, but let's have that pullback. I'll be the biggest buyer. But say it again, I have to say, gold moved up fast and quicker than I expected this and longer, but the pullback will still be there. And good for those who bought in earlier, and hopefully they'll be wise to buy even more gold when we see that drop.
Well, let's get to the crux of your thesis regarding this deflationary bust that you see coming. We've discussed it before on the show, but we're getting new viewers all the time. And I'd just like an update in terms of the timeline of where you see us today, if you could unpack that for us.
There's many ways of looking at this. And the first thing is I have a business cycle model that I post quite a lot here on Twitter, and people can go in and take a look at my profile there and find it. it clearly has given us all the recessions for the last 50, 60 years. So when we have that crossover, you're going to get a recession. That's what the business cycle model says. Then there'll be some people say, oh, this doesn't happen this time because everything is different and blah, blah, blah. I'll say, okay, I can't argue with that. I don't even want to go into that direction, trying to argue with that. What I will say is that we're not there yet. The moment you see a recession starting to unfold will be the moment when we start to see the yields declining fast, the short-term yields. We haven't seen that yet. We need to see also the yield spreads actually starting to develop. So the 10-year minus the 2-year has actually uninverted again, which is a signal that a recession is coming. It's not spiking as fast as it should just yet. And especially if you look at the shorter time frames, you look at the 10-year minus the 3 months, you will actually see that it hasn't really spiked yet. It's just actually inverted again. So this means that there is still time. If you look at the very short-term yields, you don't see the 1-month yield and yields and so on starting to decline fast. If what is like what they should, if we should see a recession, then so we're not there yet, and we are not there in terms of the stock market just yet. Into April, I said this is not the decline, this is not the recession, because the business cycle was quite clear on that. But we are getting closer. I want to say this. So when? Well, I think you're going to see 6,800 on the S&P first of all. So let's say call it by when we see something. We're going to see 6,800 on the S&P. That's one thing I want to call. I think you're going to see Bitcoin reaching 150,000 on Bitcoin. That's we're going to see. And then you're going to see that there will start to see some deterioration in the labor market as well, which means that we're going to see worse non-farm payroll numbers. I think that can come any month. It doesn't mean the recession is right there. You will hear claims of that, but it doesn't mean that. But it will start to roll over. That is clearly also what the business cycle model tells us. So there are some things I would like to see first, which is on the yields, the yield spreads, the levels that we should reach in the market. That is what I want to say first of all. And then if you put a gun to my head and say, when are you going to see that, Henrik? And I have to say, well, I think we could see this developing into a market top around Q3, which means that the market top will then have, will precede the onset of the recession by a couple of months, like what we saw in 2007. So that is the kind of timeline I'm looking into.
And when looking at your thesis, I'm sure you go over contrary scenarios in your head. When you think about scenarios that could poke a hole in your outlook and create contrary outcomes, what comes to mind?
The problem is that I'm being asked of that all the time, and it's like you see these. It's like the murder case with the butler, and you sit there in court and you ask him, why is the murder of the butler the murderer? And you're like, well, it's his footprints, it's his it's his knife. He actually had the opportunity to do it. He had all these things. And then, somebody needs to poke a hole in that and say, hey, why? But, couldn't it be somebody else? And then you need to find that one thing, which is really say, yeah, of course, if this is the case, well, then, I have to dismiss it. But there are still 10 things pointing to him. This is really, really difficult in economics to say there is just one thing, because like in a murder case, you can just say, okay, if it's DNA or something like that, it's not fitting. Well, that's something that we can, then there has to be something, another case to it. But when you look at the economy and you look at hundreds of indicators, and I'm really, I'm talking about hundreds of indicators that I'm watching, I, for now, still miss to see the decline in yields and the stress in the financial markets. But that will normally start to come as we move closer to. So would I all of a sudden here, based on everything that I see, dismiss the theory and say, yes, everything the leading indicators telling me are simply not going to happen? We're going to see something completely different this time. The whole housing market, which is frozen solid, it's not going to change anything. We're going to see actually that the economy is going up from here. I don't have that. I don't have that kind of DNA clue or thing that I can point to. What I have to say is that if we unexpectedly see that the leading indicators in my index is starting to move up again, and we see that the coincident doesn't break over and run over across the line that I have, then we will see something differently unfold, which means that we're going to see the housing market now picking up very strongly. So we're going to see the housing market doing really well. You're going to see the yields are coming down without seeing unemployment coming down. Unemployment starting to rise first. So these are the things we would like to see. So we need to see a strengthening of the housing market, and we need to see unemployment staying at where it is, and then the yields coming down at the same time. If we get that, then we would get a proper soft landing. But there's nothing right now suggesting a soft landing at this point. Nothing. And this is where people say, so, couldn't it be because of Trump and somebody does something and the big beautiful bill, or no war in the Middle East, but that's not how the economy works. The economy is a supertanker. And right now the supertanker is turning, and the turn can we prevent that? Sure, but it requires a lot of force and momentum, to turn in the other direction again. And I just don't see that right now. Actually, I see the opposite. I see a very stubborn Fed right now, as I started saying here also, that is not looking at the momentum of the turn, but they are looking at the levels, which is ridiculous. So we have inflation level at 2.5%. We actually saw it at 5%, 4.5% going into the financial crisis, actually into the recession. But it was not like inflation was a problem when we stood by the end of 2008. Deflation was the problem. Right now we have inflation levels that are much, much lower, but we have a slowdown of the economy. So I just don't see where this should be coming from. So if the Fed completely changed their direction here, and we unexpectedly saw this improvement in the first of all, in the housing market. The housing market is, I don't understand why it's not all over the news. The housing market in the US is frozen solid. And it means that people can barely, sit in their own homes. You can just look at the delinquency rates on mortgages, on credit cards, and so on. And this is the slow turn of the economy. And yet the Fed is saying, yeah, we think that the reason for the bad, consumer confidence levels are simply because of the tariffs and so on. So they're jumping to conclusions on that. Really, it's about their ability, the consumer's ability to pay. So I would need to see a lot of that. And I can't point to one thing and say, oh, if you get a good NFP number, then all of a sudden things will change, because we know they can be revised. It cannot be because the Fed comes out and do 2 cuts, because that may not be enough, probably will not be enough. So all these things need to be, changed in the complete picture of hundreds of indicators, whereas the 75 of them right now are very clear, saying we're going to have a recession, you're going to have a bad recession.
Let's end on discussing your economic outlook for Europe, as we both sit in Europe today. How do you see the picture economically? Do you think Europe will also go into this global recession? Is there any resiliency here? Is there weaknesses that you see? We obviously hear a lot of headlines about Germany deindustrializing, a lot of economic problems being faced by European Union member countries. How do you see this picture unfolding?
So first of all, the driver of the economy, or the main driver of the economy, is whatever happens in the U.S. So if it wasn't for the U.S. at this point, I'm pretty sure we've had a recession, global recession at this point. It's because of the ability of the U.S. economy just to maintain strong. We have not seen that in the European economy. The European economy has been stalling. The growth in Germany has been stalling. Manufacturing and so on has been stalling. And we did have some better growth rates than the U.S. just in the previous quarter, but that was because of some technical things with the GDP, how you measure GDP. But I don't. Yes, is the answer. Europe is going to see a recession. Europe is probably going to see an even worse recession, because still, the U.S., even though we're going to see, I think the debt problems in the U.S. is going to play out this time also in the U.S. But thinking that will be an isolated problem to the U.S. when the U.S. dollar is everything in the world. It's it's everything. It's 65% of all the loans in the world are denominated in the U.S. dollar. So if there's happening something there, you'll see that the dollar is going to rise quite strongly. That means that debt levels in a lot of world in Europe will also rise, which will the debt burden will rise, and that will become a problem, and especially for some of the southern European countries. And we don't have, common fiscal policies, and you're going to see all of these things developing again, like we saw already before in the financial crisis. This time just bigger, because all the countries, even Greece, that we kind of saved in 2011, was never saved. It was, we gave them some loans with, lower rates on it, the yields on it, and they could pay that. And then they could actually, expand their debt into, as the economy slowly starts to rise again. But right now, if that is going to develop in the US, I think these problems will be even bigger in Europe. So I don't think Europe will be able to stand alone. It will not be Europe pulling the US out of the recession, not with the current monetary situation and landscape we have. It would be a different thing if it was that we didn't have the dependency on the dollar. But I think, unfortunately, a lot of the things that we're going to see and the bubble in the U.S. equities and assets is going to play into Europe as well. But the thing is, the European companies and the stock markets are not as overvalued as you see in the U.S. So I think there can be a bigger crash in some of the in the US, but it will not be good because again, having the largest economy of the world, potentially having a big decline and seeing a big crash in the stock market is not something that's going to bode well for what's happening in Europe. So Europe, China, Asia, and all that is going to see something bad coming out as well. And there are some pretty bad looking charts in both in Europe, but especially also in Japan, actually. So I don't think we're going to stand alone. This will be a global crisis. It'll be needing a global fix, and this time a fix with more quantitative easing, monetary printing of money will not solve the situation. Actually, I think it's going to make it worse this time.
Henrik, tell us about your work at Swissblock, where it is people can find it.
Yeah, so the best thing is to go to my X profile or to X and find me there at Henrik Zeberg. And also, what we do is that I'm the macroeconomist at Swissblock, which means that I do my forecast for our customers, sit and talk with hedge funds, high net worth individuals, corporations that wants to have this kind of insight based on the business cycle model, based on how I go to market, and then. That's what I do. And then we also, of course, we deliver reports for our customers and also for retail customers, which have a more focus on the crypto world. But we also started to move into other asset groups at Swissblock.
Great. Well, I'll put a link in the description below to your profile on X as well as the Swissblock website so people can check it out. Thank you so much, Henrik, for coming on the show and sharing your knowledge with the audience.
Thank you, Jesse.
And thank you for joining us today. Take advantage of ARK Silver Gold Osmium's specials right now. Silver Kangaroos 2023 1-ounce coins, only $2.47 over spot. Silver Maple Leafs 2025 1-ounce coins, only $2.87 over spot. While supplies last, reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arksgo.com. And make sure to tell him that Commodity Culture sent you. And guys, pick up your Commodity Culture merch. Hats, t-shirts, mugs, hoodies. Everything is backed by a quality guarantee. If there's anything wrong with the product, we'll refund you your money or get you a new one. Hit the link in the description below to buy your swag now. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.